All right, we are live. We're going back live. It's just after lunch, and we're here with the other important facet of H66, which is the financial modeling that was done by request of the sponsors for the proposal that's in H66 for family and medical leave insurance. Joyce, first of all, good to see you in 3D for the first time in 3 years. And we're here with Patrick, who introduced himself a couple of weeks ago. And Joyce, we're just going to go around the room because, like a lot of the other committees, we have a lot of new folks who are new to the job, but also new to this committee. And so, Representative Tom Stevens from Washington-Chittenden District.
Representative Kathleen James from Bennington 4, which is Manchester, Arlington, Sandgate, and a sliver of Sunderland.
Representative Sadia Lamont from Lamoille, Washington District.
I'm Joe Parsons. I represent Topsom, Groton, and Newbury.
Emily Krasnow, South Burlington.
Ashley Bartley, Fairfax, and most of Georgia.
Caleb Elder, Addison 4.
Dennis Lavani, Linden, Sutton, Newark, Sheffield, and Wheelock.
Hi, I'm Elizabeth Burrows, and I represent Heartland, West Windsor, and Windsor.
And I'm Larry Laban, and I represent Essex Orleans District 1.
I'm Mary Howard, and I represent Rutland District 6.
And Robin Chestnut Tantrum and Rutland Bennington.
So Joyce, we've had 2/3 of the bill walked through. We walked through most of the wage replacement section of the bill. And so we just wanted to get an idea of, I think plenty of questions were asked yesterday, but I'm sure we have plenty of questions to ask today. But if you could start by taking us through the modeling processes that you went through to get to this point, who you work with, how you work with them, how you came up with the size of the premium, the amount of the premium, and so on. That would be great. Welcome.
Thanks so much. For the record, I'm Joyce Manchester with the Joint Fiscal Office, and
I'm Pat Titterton, also with the Joint Fiscal Office.
And we are both responsible, I guess, for modeling paid family leave this time around. I'm trying to hand off some responsibilities to the younger folks. So Pat is the guy.
I know how that feels. She's not gone yet.
And it's great to have somebody to talk to about all this stuff. Thank you. For those of you who don't know me, I've been here since 2014. I spent most of my time in DC working with the Congressional Budget Office and also with the Social Security Administration doing economic research for them. I'm an economist by training. And yeah, it's nice to see everyone in person. Great. Okay, so we put together some slides that will talk to you about the kinds of assumptions that we have to make when we're doing modeling. And we're also going to talk about the model that we are using. It's a little bit different setup this time from years past. So we'll go through that in some detail as well. So first, what are the decisions that you have to make when you're setting up a program of family medical and leave insurance? First off, what types of leave, and we'll be showing you the types of leave that are in the bill. Who is eligible for benefits? Do they have to have a minimum level of earnings? Do they have to have a minimum amount of time working in the state? What are the parameters in the benefit formula? So that's how many weeks do you get for what kind of leave, and what's your wage replacement rate, and all of those good questions. How much do administrative services cost? Right now, you'll see we're making a very simple assumption because we don't have the specifics on exactly who's doing what and how much they think those administrative services will cost. And finally, how is program revenue raised? And as you know, the bill is assuming a payroll tax, but they do make certain assumptions about what part of the wage distribution is taxed for this program. So first off, types of leave, and did you get through this part of the bill to talk about types of leave? Okay, so I won't go into great detail, but it's covering own serious illness, a person's own serious illness, a family member's serious illness, the adoption of a new child or the birth of a new baby, foster care when you are receiving a child, military families, covering some needs of military families, safe leave, also known as domestic violence leave, and bereavement leave. So the big questions for modeling are, okay, we have these types of leave. How many people will take each type of leave? And how many weeks for each type of leave? Based on the maximum allowed, how many people will take how many weeks of leave in each type? So we'll talk to you about how we get there. What about benefit eligibility? Well, the bill says you must have contributed to the program. You must have earned wages from which contributions were withheld in 2 of the last 4 quarters. And any amount of wages in each quarter is sufficient. So that last bit gives me some pause because it says if you earned $10 in each of 2 quarters in the last 4 quarters, you are eligible to apply. Now, your benefit would be minuscule because, of course, it's your average weekly wage that you would receive in benefit. So it would be, $10 in 1 week, presumably stretched over the quarter, which was, the year, I guess, which was, okay. It would be $20 you would have earned in the year, and that would have to be divided into 52 weeks, and that would tell you your weekly benefit, right? So minuscule leave, yet there would be a heck of a lot of administrative expense if somebody applied, went through the whole process to get that benefit. So that's something to think about. Another big question under benefit eligibility is, does the program include self-employed individuals or not? And if we do include self-employed individuals, is it a voluntary system so that people have to sign up? Or is it mandatory? Every person is enrolled automatically. If the self-employed person opts in, for what period of time do they opt in? The issue here is one of self-selection. If you decide, well, I plan to have a baby next year, therefore I'm going to enroll in paid family leave for next year, and then I'll drop out after that because I don't anticipate any more need. That would be a very expensive system because you have people who sign up for the particular year in which they need to use the leave, right? So you want to be careful about that. And if a self-employed person opts in for a certain amount of time, how do they continue to opt in after that initial period of time? How to re-up that enrollment? So all those are good decisions that have to be made. What about parameters in the benefit formula? So the first most prevalent, most important maybe decision is the reimbursement rate, or what percent of weekly wages would be paid out. In H66, the decision was made to pay out 100% of a person's own weekly average wage up to the statewide average weekly wage. Now, if that goes forward, Vermont would be the most generous benefit of all states with paid family leave programs. What we've seen is that, and we have a nice table that we can refer to if people have specific questions, but what we've seen is that many states use 60%, 80%, 85%, I think is the largest that we saw. Some states have tiered levels of wage reimbursement. So maybe they reimburse 90% or even 100% of wages up to half the statewide average weekly wage. And then maybe they reimburse 55% or 60% of wages between half and the full statewide average weekly wage. Okay, so lower income people get a higher benefit replacement rate than people moving up the scale. And then once you get to the average weekly wage in the state, you don't get a benefit beyond that. So the benefit is capped. Okay, so that's a very different system than saying 100% of your weekly wage would be reimbursed up to that statewide average weekly wage. So that's something else to think about, and certainly affects the cost. It also affects the take-up rate, right? How many people are using the leave? And if your goal is to get the most people to use paid family leave, then you want to have a generous rate. The last comment I'll make on this is that many states go up to 85 or maybe 90%, in part because when you receive a weekly benefit from a paid family leave program, you are not paying Social Security taxes on it, and you may not be paying other kinds of payroll taxes on it. So if there are others in the state, so you would be paying income taxes, but maybe not some of the other automatic withdrawals that come out of your paycheck. So it's worth thinking carefully about that reimbursement rate. The maximum weekly benefit is another important parameter that we can set in the model. The waiting period, if any, do you have to wait for a week before you can, so do you have to be out on leave for a week before you can start collecting benefits going forward? In the bill currently, there is no waiting period. The states seem to be split on that. The length of various benefit leaves, and we'll have a nice table to show you on that in just a moment. The maximum total number of weeks taken per year. So this is an interesting one that does vary a lot across states. Currently, the bill says 12 weeks maximum across all types of leave. Some states have up to 30 weeks. It's quite impressive, but that's a decision that you all have to make. Two items that I don't believe are currently in the bill are the last two here. The first is the minimum number of leave hours taken. So is it possible for a person who has, for example, a recurring medical appointment because of follow-up care, is it possible for that person to take 2 hours every month to go to that medical appointment under this paid family leave program? Or do you have to take a minimum block of maybe half a day, maybe 4 hours, or maybe it's a full day, right? So I don't think that's addressed right now, but it might be helpful to think about that.
And weeks would be just business days, right? I mean, just obviously.
5 business days in a week.
Whatever the business, I mean, if I worked over the weekend, whatever, it would just be.
Right.
An assumption that it was 5.
And if you work 2 days a week normally, you would get 2 days reimbursed, yeah. Okay, and the final parameter that I will mention that's not currently in the bill is intermittent versus continuous leave. So if you apply for paid family leave, does it have to be, a period of time of 4 weeks continuously? Or, like I previously mentioned, could you take 2 weeks once a month? 2 hours, 2 hours once a month in order to go to that recurring doctor's appointment. So that's something to maybe think about.
Duplicated slide.
Oh, I had a duplicate slide. I'm sorry about that. Okay, so Pat is actually going to talk about the parameters. I may have stolen some of your thunder.
It's okay. Well, Joyce set this up nicely. I mean, I'm sure you went through a lot of this yesterday, but of the things that are covered in the bill, you can see here that you have own health, maternity, paternal, family care, which that falls under the sick child, sick spouse, and sick parent was the third one, and then there's the safe leave and bereavement. So that's the universe of types of leave that are in this bill, and then so there's an overall cap of 12. So you could take 2 weeks of one, 2 weeks of another, 12 weeks of one, but altogether it has to add up to 12. So it's not, you couldn't take 12 of each one individually. And there's a stipulation that 2 of your 12-week cap can be for bereavement. The other piece is that it is saying that the maximum weekly benefit is 100% up to the Vermont average weekly wage. For 2022, the average weekly wage, according to the Bureau of Labor Statistics, was about $1,100. So that's the most you can get based on this program outline. And there isn't exactly a waiting period, but there is some language in the bill saying that when someone applies for one of these leave types, their eligibility has to be determined within 5 days. In some cases, that can be extended up to 15. But if they have to start their leave immediately, they'll essentially get reimbursed after the fact once their eligibility's been determined. So if we're good there.
Representative James.
Thank you. And I apologize. I had to miss committee yesterday and I'm still catching up on all the testimony. So I just want to make sure that I'm understanding. The maximum weekly benefit is the 1135 per week. So there will be some certain percentage of folks who earn more than that. They're still contributing whatever the payroll tax percentage is, but they're going to cap out at the 1135.
That's right.
Okay, thank
And if
you.
you're earning, just looking at the other side, if you're earning below that, you're going to earn up to whatever your wage is, even
Yep.
if it is below.
Yep, I figured that. I just wanted to make sure that
It works
I was
both ways,
understanding the
yeah.
cap. Okay, thank you.
Okay, good. Okay, now we come to administrative costs. You have to think about two kinds of administrative costs. There are one-time costs, setting up the system, developing the software, writing the rules, all of that setup stuff. And then there are ongoing costs. What does it take to keep the program going? So at the moment, we don't know much about the setup costs because we are waiting for the treasurer's office to get up to speed and think about what their needs will be.
Question, Representative O'Donnell.
Thank you. And setting all this up, you said other states have it. Can we get some of that software or get some expertise from them to implement it?
Wouldn't that be nice? So as you know, we've been around the block a few times on this program, and we have talked to various people about trying to piggyback on existing software. What I'm told is that every state has such different setups in terms of wage data and application routes and paying out benefits and so forth and so on, that it's really, really difficult to just buy somebody else's system and then
Tweak it.
So, you look at Washington State, they just set up their program for $80 million. And you think, wouldn't they like to get a payback from us of, let's say $5 billion, whatever. But I'm told that systems are so different that doesn't always work.
Thank you.
Representative Creston.
This is going far ahead, but if it was ever a federal, you have experience obviously in that. If there's a federal program, that would really cut down on a lot of money.
Yes.
For a lot of states.
Yes.
So
absolutely.
Yeah. Okay. Thank you. And do we get to the projected cost of?
Oh yeah, we'll get.
Oh, sorry.
Yeah.
All right, I can't wait. Thank you.
Yes, indeed. Under setup costs, one thing I haven't mentioned yet is establishing a special fund that would be set aside for family and medical leave insurance. And generally speaking, you like to start up a new program with money in the bank, so to speak, so money in the special fund to cover the upcoming benefits. So that's what the special fund would do. And I may be jumping ahead a little bit, but right now the bill would start collecting taxes from folks 15 months prior to making the benefits available. So that's in part to fund this special fund from which benefits will come, but it's also to help pay for all those startup costs, software development, IT hardware, personnel, rulemaking, all of that sort of thing.
Yeah, you might also hear that special fund referred to as the reserve, just kind of same terminology.
Yes.
If Damien covered that yesterday.
Representative Parsons.
In the bill, it's in there somewhere, I'm sure. I think it says something like 20 million comes from the state as their initial,
That's a placeholder.
okay. I didn't know if that represented that 15 months for all state employees or if that was.
No, that's an appropriation rather than the money that's being collected from the payroll tax.
So that it's an advance, it's a form of advance.
And it comes off
the
as.
language here is the credit. So if the state's contributions to their employees, that's like paying it off in advance so that there's starter money to do the hardware, to do the setup.
Yeah, I was just wondering if that represented that 15 months you were speaking of for everybody else.
Right.
Or if that was just a
Right, so
number that was taken.
that is a placeholder, and we don't yet know if that's sufficient or not sufficient or whatever, but yeah, that's the idea.
And I'm not sure if you can answer the question, but at our last rodeo,
Go round, yes.
there was conversation, but nothing was settled about that DFR had the ability to lend a program that had income. And this seems like an equivalent, though it's set up differently, basically would give a division, in that case, it would have been the Department of Labor, but the money it took to get the system up and running before funds were being collected. And I think that's what this is operating
Yes,
as.
yes, in part because we haven't had more specific conversations with DFR and the Treasurer's Office yet. So we don't know exactly what will come from those offices. It is interesting that this is going to be quite the operation that takes Department of Labor input, Department of Taxes input, DFR, and the Treasurer's Office. And they're all gonna have to be working together to make this program work. Some of you will remember that a few years back, there was an effort to use a third-party insurance carrier to run the program. So we didn't have to worry about the reserve and the software and all of that. It would have been taken care of by this third-party administrator who does similar programs for other states and other entities. But of course, you pay for that service too. And you pay on an ongoing basis, a premium so that they have the responsibility. So it is going to be interesting to see how this all develops with where responsibilities lie and how we pay for what we want. Okay, just to mention a bit more on ongoing costs, that would include personnel, IT upkeep for benefit eligibility and payout, the appeal system, because of course some people are going to apply for benefits and not get approved, and then they'll appeal, and so that has to go through the whole court system, revenue collection, and so forth. So there's a lot to be set up here. Operation generally requires 12 months expected benefit costs, as well as the administrative costs in the special fund, and then I say prudence here, but most programs have a reserve fund, which would be specified in H66 as 9 months of projected benefit payments. So that means when you start up, you really ought to have the 12 months plus the 9 months, 21 months worth of benefits in the bank. Okay. So what about collecting program revenue? Well, in part, that depends on the type of tax or contribution that is used, and H66, like previous bills, is relying on a payroll tax on wages. The question is, who pays the tax or the contribution? In H66, employers would pay at least half the payroll tax. Now, it is my job as an economist at this point to tell you that from the economist's point of view, it doesn't matter whether the employer or the employee pays the tax. It both lands on the employee because an employer's in business. An employer's not going to, find money out of thin air to pay this tax. So the total compensation package for an employee includes not only what they receive in wages and fringe benefits, but also what is the employer paying on behalf of that employee, right? So if the employee pays half the tax, that's good. And politically, I absolutely recognize that there are reasons why you want to specify that the employer pays half the tax. Okay. And what happens in the real world, we don't really know, but theoretically, it shouldn't matter who pays the tax. Okay. So employers would withhold employees' contribution just like they withhold income tax contributions. If self-employed individuals opt in, they would pay the full amount. So they would pay both halves of the payroll tax and probably in quarterly estimated tax payments. There's no withholding generally from self-employed earnings. And so they do file quarterly estimated tax payments, and this would be included in that quarterly tax payment. And this reminds me that I meant to mention that part of the modeling we have not yet done is the cash flow modeling. So we have to think about when do the payroll tax payments come into the state, and when do the estimated tax payments come into the state, and what's the flow of the benefits out and so forth. So all of that will be of great interest to the treasurer's office if they are running a special fund, just to make sure that we're not borrowing other state funds to keep this program going. The tax base.
Sure. So the key thing to figuring out what this premium amount is going to be is how much of the wage base are you considering taxable. In this bill, we're capping wages up to 2 times the Social Security max. So any earnings up to that amount, they're going to have that payroll tax rate applied to it. So one interesting thing that this bill is doing is it has this $25,000 exemption in it. So if you're an individual who's making $25,000 or less, you're exempt from this payroll tax. And the way that sort of operates mechanically is because it's difficult to sort of estimate what especially if you have multiple jobs or you work irregular hours. Essentially the way to operate is the money is going to be collected from you throughout the year, and then sort of when you go to file your taxes at the end of the year, so you get a refund. It's kind of how it would work mechanically. And so,
Representative Person.
Thank you. In doing all of this work, is there a number of people that you found would qualify for the benefit and also not be putting in towards it? Or not be required to, if that was a.
We have that there now. Oh, yes, we do.
yeah, is that this
Go ahead,
number?
sure.
Yeah, so that number is, if you see on the, second bullet from the bottom, that's that 244,000. That'd be that.
That's the number that's the number that would be
Yeah.
taxed, right?
Right.
Right. And we think that there are about 400,000 people
Right.
who have earnings in Vermont at some point during the year. So by the time you take out the people with less than 25,000 total earnings,
Yep.
you get down to about 244,000. So a lot of these may be teenagers, or they may be seasonal workers.
Well, I was just thinking like fixed income people but they're not working, so they want.
They're not working,
But they
they're not,
qualify, so I didn't know if
Right.
it would be wrapped in that 244 number.
right, these are taxpayers with earnings, right?
244,000 people.
Above 25,000, yep.
Okay, thank you.
Representative Elder.
25,000 is gross total earnings, not AGI. Is that right?
It's
That's
earnings.
yeah.
It's earnings, right? It's earnings, because we're only putting the payroll tax on earnings.
No adjustments. So it's not AGI.
I don't believe it's AGI. It's specified in
Some
the bill
wage,
as
earned wages, yeah.
W-2 earnings.
Yeah.
Representative Person.
Sorry, so, Representative Parsons' question, so it's 244,000 people who you think would be exempt, or that's that's the other number
That's the number who
of
pays.
the total who pay?
So if we're talking about
I'm curious, yeah.
400,000 workers, 155,000, something like
Thank
that.
you. Okay, thank you, great.
And just the last point is, there is a stipulation in the bill that if an employer is opting to provide an equivalent or better plan themselves, they don't need to be, they can opt out of this.
Representative Justin Tangent.
Two questions. One is actually Representative's question from yesterday about these employers opting out if there's an equivalent or a better plan. Do those plans exist on the market?
I believe so.
Your research and that are as broad as ours, including safe leave and military deployment and
I guess I don't know for sure. I would think so, but I don't know for sure.
Representative Bartley.
I had another another question, going back to the types of leave. And it seemed like most of those get a pretty good number of estimate of participants. There's, we know the number of births, we know number of deaths, things like that. Safe leave to me seems much more nebulous and is probably vastly underreported.
We will talk about that in just a minute, yeah. Yeah.
Representative Bartley.
I was just gonna say, New Hampshire and Virginia both offer voluntary leaves such as this, but they use a private insurance. So I'm not sure if it would be, state specific, but there should be federal insurance providers out there who would be able to cover something like this.
Yeah, all the pieces have to fit into, the way that this bill is written, all the pieces have to fit into place. They're gonna have to offer everything that's in this bill and come in at a price that's considered as at the same price or below. Okay, Representative James and Lamont.
Thanks. What's the fiscal rationale for exempting wages beyond the Social Security max?
So right now, we tax wages for Social Security up to, we're talking 2022, so it was 147,000 something, right? And so you pay payroll tax for Social Security up to that maximum, which is adjusted by average wage growth every year. And you get benefits covering that amount of wages, but not beyond, right? And at the time, this goes back to my Social Security days, at the time that the Social Security max was put in place, it was felt that people would be more supportive of the program if they didn't have to pay tax all the way up the wage spectrum. So this is a way to garner political support, basically. It's also true that the 147 is far above the maximum benefit that people would get, right? So if there's a maximum benefit that's set for the system and you're expecting people to pay payroll tax up to whatever they earn, 500,000, whatever, that's sort of asking for trouble, right? So that's the reason. Now here we have twice the Social Security maximum, which is interesting. I don't believe we saw that in any other state. So they are reaching farther up the wage spectrum.
So kind of saying there's a point beyond which folks would be paying so much in, and it becomes way out of whack with what they could receive as a maximum benefit.
Absolutely.
Okay.
Representative Lamont.
That's okay, I'll pass.
And I just want to be conscious of time as well. We have another set of folks coming in at 2:15. Just as
Where's your
the clock is right behind.
Okay.
All right, Representative Bartley.
Just kind of going back to those who earn more and who would be getting less of a benefit. Do we have any inkling of how many people that might be? I feel like that'd probably be really hard to calculate.
Yes. Do we? No.
So this is kind of getting into sort of depths of the model that we did? Is there something on there?
We do
Oh,
know
we do know that.
that up to twice the Social Security maximum covers 96.3% of wages.
Okay.
Thank you. So that's pretty high up on the scale.
Sorry, was your question about receiving the maximum benefit amount or was it the full taxable amount?
So it's somebody who, I earn more than what I would be getting by using.
So that's a different question,
Yeah.
okay.
That we don't have with us.
Okay.
But I think it's something that we can sort of try to estimate through the model. It's just not an exercise we've done yet.
So you were talking about the differences, the different incomes. And when I look at the tax department's statistics on income taxpayers, they're going by AGI. So that's different than what, how do I get a bead on?
So we have friends at the tax department and we have to ask them for data, right? So it took them, a month? It took them a while,
Something like
6
that.
weeks. But they were able to give us the best data they've got on W-2 earnings. So we've got uncapped W-2 earnings. We've got capped at the Social Security max and twice the Social Security max. And then we've got what happens if you take out people who earn up to 25,000. Yeah, so just to be clear, people who earn 50,000 are gonna pay payroll tax all the way up, right? So,
Sure, but if I look at that tax document now that's based on AGI, I mean, if I'm looking at the 50 where it's capped at 50, goes from 40,000 to 49,999. That's AGI though,
yes, absolutely,
that's still gonna be different than the numbers you're pulling from.
absolutely.
Okay, thank you. Representative Elder?
And of course, it could be the same. You could, if you have no adjustments, your AGI could be identical, but it can never be higher. But it seems to me that if the weekly benefit's about $1,100, we're talking like 55,000 or so in earnings would be the equivalent. So I think anybody earning over 55 or 60,000 is basically going to pay more in than they could theoretically get out. I think so. I think that's the line, right?
Well,
you'll get this.
What you get out if you're at the average wage, I'm not sure about that.
I guess I'm just saying, like, if you had an average wage, if for your 2 periods, you've got the statewide average, it's 1,100, right? And so the only way that you would, that would be a lower number than what your actual average wage is if you make over, in theory, like 1,100 times 52 a year.
Right, absolutely.
Right. So it just seems to me that anybody who's in that category of making over 1,100 a week on average all year is by definition going to be paying in more than they could theoretically get out.
Right. And another way to say that is that they're getting less than 100% wage replacement.
Yes.
Right.
Yes. So that's kind of everybody from about 55,000 to double the Social Security. There you go.
And you'll see that the vast, the 244,000 number is, again, not an easy number to, if I looked at that same chart, it would show basically, I've talked about how many income taxpayers there are below 50,000. I think it's close to that number right there. Probably a little bit less between 200 and 244. I think it's like 225 or something like that. But that's income taxpayers at 50,000 and below. And then the other 15 or 150,000 or whatever the number is would see the declining amount.
Right. I guess, let's see, we have about 300,000 tax filers per year in Vermont? 350.
I think this last year's number was 380 and
How much? Wow.
340 were in state and maybe something like that, but it was between 360 and 380, I think.
Right, so those are tax filers, not workers.
Other tax filings, yeah.
Right, and there may be 2 people working or
Some of
not.
them were married.
Right.
Well,
So it's a
family.
different, a little different universe, but yes.
Yeah.
And of course, there are some very low income folks who don't file taxes at all. So you're missing that low end.
Which the tax tables account for, but not, again, based on AGI.
Right. Yeah, okay, maybe we should keep going. Okay, now we get to the fun part, which is how do we, the lowly joint fiscal office, estimate paid family leave and its cost? So some of you who have been around for a few years will remember that we used to use a model through the Institute for Women's Policy Research. And that model and they were responsible for the famous 2016 dog-eared report that sort of set the stage for how Vermont might do paid family leave. So the developers of that model have now left the Institute for Women's Policy Research, and the US Department of Labor bought that model and some of the time of the developers of that model, together with the services of IMPAC, which is a IMPAQ, which is a contracting firm. And they've now made the same model available to the lowly public, including JFO. So we are now using the public version of the very same model that has been used for probably 10 years to estimate the leaves that will be taken, how long those leaves will be, and so forth. Okay, so we're using a good model. Pat is the expert on the model. I'm just going to give a little bit more background and then he's going to take over. Okay, so the expected leave taking comes from Rhode Island. Rhode Island is the state with the highest level of leave taking per capita. Okay, so we're trying to be a little bit conservative here and take the highest. However, I would add a note of caution that Rhode Island does not have 100% wage replacement. And so, yes, they're the highest state in the country currently. If we had 100% wage replacement, it's possible that we would have a higher level of leave taking than we are modeling, okay? Secondly, we don't have good information on administrative costs, so we are assuming 7.5% of the benefit cost has to be added on to the cost of benefits in order to get the full program cost. And again, we may be conservative there, but we won't be sure until we have actual startup costs and ongoing administrative costs. So I've already said we haven't looked at monthly cash flow and specific startup costs. So that's where we are on modeling. We feel relatively good about the modeling. But
we're still saying it's preliminary.
Yeah, it's definitely still preliminary and we're learning things as we tweak it. But
my guess is that until policy is pinned down, you can't be super precise. Is that, because we're gonna talk about all the different variations and that'll change.
Absolutely.
Can you go, so expected leave, what is Rhode Island reimbursing at this point? Do you know? Because several years ago, it was only like 40%, which the level of wage replacement certainly affects the take-up.
So as of 2022, it was 60% of the average weekly wage in the highest paid quarter. So if you've got fluctuating earnings over the year, they take the highest quarter. Reimbursement.
And do they cap it?
Yes, the maximum weekly benefit is $978, and I'm not sure how that relates to their average weekly wage, but there it is, $978. Would be a bit less than ours.
So just, and for committee, Rhode Island has had this system in place probably since World War II. For a long time, the only state that offered this, and they also offered it at 40% for a very long time. They just raised the rates over the last few years, but we would use them as an example of a very, very, very mature system as opposed to the number of states that have started in the last couple of years, and there's not enough data back up to see what the success rates are. Okay. All right, Pat, all you.
Great, so we're using this model that we've talked about a little bit. It allows for us to get at most of these parameters that we've talked about. And if you're familiar with that 2016 report, this table should look somewhat similar. But there are some back-end adjustments that we're having to make. Things like safe leave and bereavement aren't actually available in the model. So those are two where we're, for safe leave in particular, we used a similar method to a report that was written by, I guess, power users of this model.
In Maine.
In Maine. And what they relied on was, national survey data and sort of what reported statistics are available. They included in their report that same caveat you were referencing, in that, it's an underreported crime. So it's possible that the estimate, the way the Maine report presented it, it's possible that the estimate's kind of high, just because of that whole issue with underreporting. But what we are able to do is sort of use these Rhode Island take-up rates, apply it to Vermont US Census data, and then some other database that's available through the software, and come to sort of expected number of leaves taken by category. So that's that first block you see there. And in doing that, we're sort of able to figure out, or it spits out also what their expected benefit is, and that's getting at some of the census data that it's pulling from. So we're able to calculate for the other leave types an average weekly wage, or average weekly benefit, and sort of apply that in building out those estimates. So we talked earlier that max is the 1,100 figure. What we're estimating in this is that the average would be closer to the 550 range. And I think if I were to show this again, I might not give so many decimal points, because that makes it seem very precise, right? It is an estimate. So just calculating the cost based on the number of leaves taken, how long those leaves are, and that average benefit, we're able to get to that top line benefit cost that you see. So that's 79 million figure. And then we further break that down by the different leave types. You can see that own health is by far the most utilized, in Rhode Island, I guess. It's got the highest take-up rate. And then, once we get through that, this is where we get into that big slug of money that has to do with administrative costs. That does not account for the appropriation, that 20 million that we referenced earlier. It does not account for any one-time startup costs. This is just sort of ongoing expected. And then 7.5%, it's the same assumption that was used in that 2016 report. For example, the Maine report used 5%. But without looking or without knowing how it's going to be structured and administered, it's hard to say. So as we go along, that's something that we'll be able to refine. So with the administrative costs, we're estimating about 85 million a year. And one thing, if any of you are particularly eagle-eyed, in the bill, you notice that the premium rate was set at 0.58%. We've been doing some more, I guess I'll call it fiddling with the wage-based data, in particular thinking about inflation and how that's affected it since, the actual data that the tax department collected between then and now. So just making those adjustments and thinking about that a little more critically, it's grown. If your wage base grows, your denominator's growing, which means that your overall ratio is going down, meaning that the tax rate's coming down here. One thing that is probably an important caveat is we haven't been able to figure out that, we referenced the quarterly estimated payments from self-employed people. So we have them included on the cost side of this equation, but we're still working through and figuring out the most appropriate way to factor them into the wage-based portion of it. And that's something we're working with the tax department on. So part of why we want to caveat all this as preliminary, because there's still some key pieces that we're working through to, better fine tune that. But I think what you see here is sort of a good first pass given the parameters that we know concretely.
Would you consider these numbers conservative, and in fiscal talk, conservative would mean higher than, it's a choice of how you define it. So if I say it's conservative, then I'm saying this could be more expensive, or this could be higher number than what it might be in real life. But again, that's a choice interpretation. Do you guys refer to it, do you think in those terms?
So I see some offsetting factors. If you look at maternity parental leave, you see 6,900 leaves. And we know that births in Vermont have been closer to 5,400. I'm bumping numbers up a little bit since 2021 because of the COVID impact. But they've not been 6,800, 6,900. So maybe that number is a little bit high. On the other hand, we've got Rhode Island with a 60% wage replacement rate telling us how many leaves are taken. And I think those take-up rates are going to be too low for Vermont if we stick at 100%. So I think there are a number of factors that could go either way. And we're just kind of playing around to test sensitivities a little bit. So I don't have a good answer.
So this estimate is, if I've done my math correctly, this is 5.5 cents on every $10 of income, basically, would be the premium costs. And on an annual basis, when the rates are set, I mean, you would determine, or the proper authority would determine how big the reserve fund is, what the expectations are, and that premium can shift back and forth, much like workers' comp does. Is that how this would work? So if we find that these numbers are conservative and we're actually at a lower usage, the number would go down, and vice versa. If we found that there was a higher take up than what was anticipated, it would that premium would go up.
Right. So I think in the bill, there's an annual report to the legislature that says, okay, this is the past experience. This is how many dollars of benefits were paid out, and this is how much we had coming in revenue, and we're either short or we're too high or whatever, so we have to adjust the rate, and that's up to the legislature to adjust the rate. So that will happen over time. I think the tricky part is setting it up so that you're in the ballpark, so that you can move forward without a shortfall.
Okay, we have 5 minutes in order to take some time and go to the next. Representative Elder?
I'm good.
Representative O'Donnell?
I just, a quick question. Right at the beginning, you had types of leave and you had military families, and I haven't been seeing it in the last couple of slides. Is there a reason why that was left out?
I'm not sure that's in the bill. Is it in the bill? I don't.
Military leave is in the bill.
Is it? Okay. So.
But it's part of it's just part of the overall. It's not broken out like bereavement is.
Okay, we can check to see if it's mentioned in the model. It may not be specifically.
I think I know the answer, but I don't want to say it because I don't want to be wrong.
Representative Barley, did you have a question?
Sorry. Never seen.
All right. Where are we? Are we done with slides or?
That's all of our slides.
Thank you.
Oh, I was,
No, thank you.
thank you.
So committee, just in general, first of all, thank you, Pat and Joyce.
Thank you.
We will I appreciate taking us through. We will also acknowledge, as you were saying, that these are preliminary numbers.
Thank you.
Which, if they're quoted, they're going to be quoted with quote marks around them. We, in committee, when we're dealing with this bill, which we will be very much over the next couple of weeks, our focus is the policy primarily. So we're going to be focusing on the text, on the words, and we're going to be paying attention to the numbers. But once we're done on our work, and if it passes through committee, it goes to Ways and Means next, which will be when their work will go under a microscope that's far more powerful than our microscope in terms of raising revenue and how it works. And then it will go to, if it passes through that committee, then it would go to appropriations to deal with that, if we continue the language that says we want to see a $20 million appropriation, then it would go to the appropriations committee. So our focus on this bill is the first the first crack at this bill is on the policy, is on the working through the language of who we're asking to be covered by it, just how it would work. And then we would give up ownership of the bill at that point, and then it goes to the next committee, and then the next committee before it comes back to the floor. So just, we will see these folks again and again and again. If not in this committee, then throughout the process on the bill, so.
Could I offer one last comment? And that is, some people have asked why the rate in the 2016 report was 0.93%.
Yeah.
And I can't tell you how many times I've read this report and pieces of this report and so forth. So this past December, I went through the report trying to answer the question, why is their rate so much higher than our rate? And the one thing that I find that can explain that difference is that they say in the report that the maximum weekly benefit is capped at the state average weekly wage, which at the time was 400 something. But the average weekly benefit they show in their tables is something like $732. I mean, it's way above the maximum. So it must be that they did not implement the maximum weekly benefit when they ran the model. And if you think that the average weekly benefit goes from 700 whatever it is down to 400 whatever it is, that would account for a big chunk of that drop in the tax rate. So why didn't we figure this out? We've looked at this for years. And why hasn't someone else figured this out? I don't know, but that's my best.
But we almost did figure it out last time because the bill as introduced in 2019 had the 0.93. But by the time it left our committee, with your numbers, it was down to 0.58 or 0.55.
Right.
And by the time it got through, and then there were policy choices, and by the time it Senate and came back, it was at 0.2.
Right.
But that didn't include personal leave.
Right.
You know, and so so I would just want to leave it there. We could go on and nibble at the corners of it, but I think that it's reflective of the work that JFO's done, that these numbers are still so consistent is pretty impressive. So thank you. I need to take a break. In committee, let's just do like really 5 minutes if we can. We have folks from Mental Health Advocacy Day coming in. So thank you both. And,
Thank you.
Thank you.